Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to another episode of Zach's Top Stock Picks of the Week. I'm Tracy Reinick, and I'm joined this week by Ben Rains with two of our top number one stocks, and they're very different industries. I have one of the hottest retailers. In fact, my retailer has been one of the top performing S&P 500 stocks of the last 5 years. But Ben is bringing you something in the infrastructure building side of things, because that has also been really hot here in 2024. What makes my stock, which is Deckers, ticker DECK, such a big winner? Why does it have the number one rank once again? I want to say it's had the number one rank for most of its last couple of years. And a lot of that is because it continues to beat and raise. It's defying all odds on the retail side. I mean, it does not see any slowdown in its consumers and its customers. And so it continues to hit new sales records. A lot of that is being driven by its hottest brand, which is the Hoka brand. Yes, they make Hoka, but UGG, their traditional old standby now, as it's going to be called, is also picking up steam and seeing quite a nice double-digit growth trajectory here as well. That's good management of that brand, because it kind of had become kind of just their regular stable type brand, but it's doing innovation on the product side, and that is pushing sales higher. In the second quarter of 2025, it saw sales up double digits once again, and domestic up nicely, but international up 33% in that second quarter. That is a big gain for its smaller market. International is its smaller market. So it is picking up steam on all categories. It has sold off one of its smaller brands now to focus on the bigger brands. It also has Teva, or Teva, not sure how you pronounce it. That's been a popular brand as well, just not on the same scale. So last quarter, it only saw sales a little over 20 million, but they were up 2.3%. So that's on top of the gains that UGG and Hoka both saw as well. So things are looking good. What do the numbers look like? Why does it have the Zach's number one rank yet again? Well, in last quarter, it did beat and raise. It raised both sales and earnings guidance. But let's take a look at what the numbers actually are looking like and how we are getting here. So on Deckers, again, ticker DECK, you can see the Zach's number one rank there. Style scores all much lower, but this is kind of surprising. I never understand how we get the D for growth when it has very good growth. The F for momentum when the stock is hitting new highs, but it is what it is. That's the little misleading part, but not on value. These shares are expensive, trading at 36 times on a forward PE basis. For a lot of other growth names, 36 times might not be such a big deal, but that is historically a little more expensive than what you paid for Deckers over the years, where it's been around 28 to 32 times. Now we're starting to see these valuations stretched as the stock continues to move higher and hit new highs. Now I'm on the detailed estimates page. We're going to scroll down. You can see on the sales growth for this fiscal year, they did raise it, and now expecting a 13.5% on the sales growth coming off of a very nice year last year, and then another almost 10% for next fiscal year. But that's a little early because we haven't even made it through the holiday season, which is one of its big seasons here. And then we'll see what's looking like for next fiscal year. But you can see on the earnings side, up another 12.6% and then 13% for next fiscal year. But this tells the tale here. 10 analysts higher in the last 60 days for this year, 9 for next year. And these numbers are coming off of that second quarter earnings beat and raise, where all the analysts have to raise. But we do have one that's still bullish and getting more bullish in the last 30 days, maybe seeing some of these other companies reporting holiday numbers that have exceeded expectations. And if anyone's going to exceed expectations this holiday, it is going to be Deckers. So that's all looking good. What does it look like on the price and consensus chart? Because that's my favorite chart. And we're going to take a look there. Of course, looking very good up and to the right. This is what you want to see. A little bit of a slower growth may be happening here. But like I said, for these next few years, we're just now starting to get some of those analyst estimates in. And it's a little early to know exactly what the consumer is going to be doing into next year. So everyone's remaining cautious. Now, they did give a range of $5.15 to $5.25 for this year for the earnings. And the Zacks consensus is at $5.47 now. So the analysts are still thinking, they're being a little conservative. We think they're going to do even better this holiday season. So we're going to go a little bit above what they're projecting. So not surprising because Deckers has been on the more conservative side over the last couple of years. Now, as I mentioned, it's one of the best performing stocks in the S&P 500 over the last 5 years. As you can see on this chart here with the breakout here, it is up 607% in the last 5 years. And then even just year to date, it's up 78%. I've always loved Deckers. I've kicked myself for not buying it several times, including back here in 2022 when they had excess inventories and they actually missed on earnings. But that was the supply chain issues which have solved themselves. So the stock is off and running once again. And I haven't really had a time where it's been cheap enough for me to get back in. But if you're a growth investor, if you love growth stocks and you're looking for one of the top names on the retail side that hasn't faltered whatsoever, then Deckers is the one for you. I am expecting another great holiday season. The only question is, how much do you pay for this stock? Right now, I'm paying 36 times, but it is executing. Would I pay 40? Would I pay 45 times? I'm not so sure. I'm not even paying the 36, but as even a growth investor, you're starting to see a little bit of stretched valuations there. But again, they have been executing. So I still really love Deckers. We're going to have to wait and see, but this holiday season is shaping up for all the retailers to be an excellent holiday season. So I'm going to keep an eye on this one. Definitely watching the next earnings report, which will tell us about how good it was. But Deckers, nothing is stopping it here. Ticker DECK, still a strong buy stock. And now I'm going to turn it over to Ben with his construction number one stock. And you might think construction is boring, but not so much when you look at that chart.
Thanks, Tracy. Hello, everybody. Ben Rains here for Top Stock Picks at Zacks. Today, we're looking at MasTec, which trades the ticker MTZ. MasTec is a leading U.S. infrastructure construction company, and it benefits directly from the broader energy transition, electrification, grid improvements, and expansion and other key long-term trends, including the AI boom. The stock broke out to all-time highs relatively recently, and MTZ has crushed the S&P 500 and the construction sector over the past 20 years. Wall Street is also very high on the stock. So let's dig a little deeper into MasTec by taking a look at their website to see all the different areas of the economy that they're exposed to. So overall, once again, the company is a leading national infrastructure construction company, helping build, install, and maintain and upgrade massive projects across energy, communication, utility infrastructure, and beyond. So we can see here energy transition solutions, various segments of that, electric vehicles, we can see oil and gas, power generation. So just massive long-term upside in a lot of the businesses that MasTec is exposed to here. So we don't need to get any deeper onto that. So now I'm going to go into our Zacks.com ticker page for MasTec. We can see that it's a Zacks rank number one strong buy stock with an A grade for growth and a B for momentum. We can also see that it's building products and heavy infrastructure, is in the top 14% of roughly 250 Zacks industries. So that's a great sign. And And overall, people are bullish on MasTec as well, with the Trump trade encouraging more reshoring and just building out broader energy infrastructure in the U.S. So that's benefiting this entire industry as well as MasTec individually. So we can see right here, we're calling for roughly 2% revenue growth in 2024 and another 9% growth next year. But what we're looking at too is this massive 84% bottom line growth in 2024 and another 45% growth next year in 2025. And then we can see that its estimates have trended heavily in the right direction since its last report, going from $3.02 all the way up to $3.63 for 2024, and then jumping from roughly $4.38 to $5.28 for 2025. And we can see it has an impressive history of bottom line beating an average of 40% in the trailing 4 quarters. And now we're going to go ahead and take a look at our ZRS system here for MasTec. And I'm quickly going to start by looking at its recent growth to put the revenue growth in perspective. So the company is coming off a huge 23% growth last year, 23% growth in 2022, 25% growth in 2021. So just growing 2% this year is up against that massive growth over the last several years. And then we're doing another 9% growth next year for MasTec. So really impressive stuff. And you can see that the business is exposed to just various areas of the US economy. They're going to be key both in the near term and the long term. And now we'll go ahead and take a look at its performance. As I mentioned up top, it's outpaced the construction sector and the S&P 500 over the last 20 years. So we can see this is a 20-year chart. It's up around 1,300% versus the Zacks construction sector, which is up roughly just 180%. And then if we put in the S&P 500, gives you a better sense of how they've outpaced that, the broader index as well. So up about 425% there. Now we'll zoom in into the last 3 years just to give a sense of what's going on. So we can see MTZ is up around 62%, also nearly doubling the S&P 500. And if we put it back to the construction sector, we can see they're now neck and neck, as the construction sector has been on a big bull run over the last several years amid all of the energy infrastructure spending and the broader reshoring of the U.S. economy. And now we'll go ahead and take a look at the technical chart, because I said up top that they also broke out to new highs not that long ago. So if we go to 5 years, we can see, put the little display data here. So we can see it tried to break out in the summer of 2023 above those 2021 levels, but it kind of failed to break out there, went down, chopped around here, tried to break out, and then it finally broke out to brand new all-time highs in late October, early November. If you can see now, it's trading at fresh all-time highs, and it's not super overheated either. So if we go to a 1-year chart, we can see it's kind of hugged that 21-day moving average, currently trading right below its recent all-time highs, and it's not super overheated in terms of RSI levels, which is a good sign. And if we take a look at its valuation, it's a little pricey compared to the Zacks construction sector, but it's also destroyed that sector over the last 20 years. So Wall Street's clearly been willing to pay up for this stock. And if we look back historically, it's still trading well below its 2005 peaks when it traded as high as 46 times forward 12-month earnings. It's now trading around 30 times. So it's not super bloated in terms of valuation here as well, and its earnings outlook is continuing to trend in the right direction. Overall, MasTec is a diversified bet on the energy transition and the rapid and massive expansion of AI and beyond. And that does it for me in this episode of Top Stock Picks at Zacks. Please head over to our Zacks.com/promo page for a look into some of our services, portfolios, and more.